Have you ever wondered what makes infinite banking different than just a typical whole life insurance policy? Well, stick around today as we unlock the secrets of the paid up additions rider.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with your co-host, Anthony Faso. And today we're going to be discussing what is the power behind an infinite banking policy, and that is going to be the PUA rider, paid up additions. This rider is often misunderstood, and so today what we're going to be talking about is what is the PUA and why you need it on your policy.
I think this is going to be a great episode, and I think a lot of listeners probably maybe already have a policy and understand what a PUA is, but these concepts are different, and I feel that we need to reinforce the ideas on what and why we are doing it. So I think even if you already have a policy and are doing infinite banking, I think getting a reminder and a better understanding of what a PUA is and what it isn't is going to provide some value.
Couldn't agree with you more, Anthony. Today, guys, what we're going to be talking about is the what and the why of the PUA rider, and then we're going to be talking about the advantages and disadvantages of having that on your policy. Anthony, you want to start us off?
I am. And before I go into the what,
I was trying to get you to go.
When we talk about explaining what a PUA is, do you know what memory that triggers for me?
Probably not. I have no idea what goes on in your head.
Probably not. When we first started out and I took you under my wing and we kind of went, to learn infinite banking back then, we had to travel. Right. And we had to go to these conferences. And I remember, we had went to an IBC. It wasn't part of the think tank, but we called it the mastermind, where a lot of the top IBC guys would meet and kind of share ideas. And I remember one time, I don't know who came to the door. I think it was Dick Dykeman, and I don't even know why he came to our door, but there was a knock on our door and you and me were sharing rooms. Separate beds, right? But he came to the door and he asked his question. And as I was shutting the door, I kind of slow played it. And I kind of let the door hang open for a little bit. And I talked real loud, but and then I waited until I was just shutting. I'm like, Cameron, as I was saying, a PUA is a paid up additions rider. So all that guy heard when he left is that here I am teaching infinite banking and what a PUA is to Cameron. So that's why I'm super excited. Do you remember that?
No, I don't remember that at all.
I do. It's kind of one of the, I've had some good zingers with you, and that was one of my favorites. So let's talk about what a PUA is. Now, PUA is short for paid up additions rider. So a rider is something that's added to a policy, and a PUA can only be added to a paid up to a whole life policy. Now, one thing that is unique about this PUA, and if we step back and kind of look at whole life and kind of the different ways that we can design them, or maybe even the different lengths of payments. Cameron, if we had laid out all of the different whole life policies, paid to 121 or a 10 pay or a 65 or whatever, which one is the most efficient?
A single premium.
Right? A single premium, meaning that you make one single deposit and that's it. Right? That is the most efficient whole life policy, in part because almost all of that is going to cash value. Then there's going to be very little death benefit. So the costs on that are low, but that's why the IRS came up with the MEC rule. And in the 80s, they came in and said, wait a minute, this is way too sweet, right? They can just dump a pile of money into it and it can grow tax-free and they can borrow against it tax-free. So that's when they created the MEC line. But if we really step back, a PUA is a single premium whole life policy. It's just attached to an existing whole life policy. And that single premium, what that's going to do is it creates its own death benefit, creates additional cash value and additional dividends. Now, since we can't do, well, I guess you can do a single premium, but we don't want it to be a mech.
Yeah.
We don't want to pay taxes. So, but what we can do is we can have a single premium insurance policy. We just got to add it on top to an existing whole life policy. And that's what the PUA is. It's just individual single premium whole life policy on top of an existing one.
Well said.
Okay. Now, Cameron, so that's the what. So what's the why? Like, why should we add this PUA rider to our policy?
When we're looking at the why, we need to look at policy design, right? And so we're designing our policies much different than typical financial planners are doing, and even just typical insurance agents, is they're all focused on base premium and death benefit. So when you pay base premium, you get a really high death benefit, but you get very, very little in cash value. That is the exact opposite of what we're doing. So for better or worse, when we're designing policies, our focus is all on cash value, and we're actually trying to minimize that death benefit a little bit to get as much cash value into the policy as we can. So what we would call kind of the traditional model of what we refer to as your mama's whole life insurance, that is an all base premium insurance policy. And again, right, very little cash value, especially for the first probably 3 to 4 years. You're going to see zeros in that cash value column, but you get a really high death benefit. What we're trying to do, right, is we're trying to accelerate the cash value inside that policy. And so why we're doing this and why we're utilizing that PUA is because when you pay that PUA, it shows up as cash value inside of that policy. So why we're using PUA riders is to accelerate that cash value in the first several years to really get that policy going and accelerate that cash value accumulation.
Perfect.
Yeah. If you guys are wondering, if you guys have a policy and are looking at it and not quite sure what your premiums are going to, whether it's going to all base or whether it's going to cash value, feel free to reach out to us. We'll have our link in the show notes. Jump on a quick call with Anthony and I. We're happy to take a look at what you have, and we'll give you some guidance. I've got a great story in a little bit about someone that did just that and really saved him a lot of headaches. So I'll share that here in a minute. Stick around. Anthony.
Yes.
Let's go to disadvantages and advantages later. I'll touch on, but Anthony, you want to share some disadvantages of the PUA rider?
Yeah, and what we want to show on this podcast, I mean, we're obviously going to talk about the great things about infinite banking and PUAs, but we want to try to have an honest perspective. Mm-hmm. There's pros and cons to both. So adding a PUA to a whole life policy is going to have its disadvantages as well, even though I think they're kind of minimal, but we still want to be transparent. And what I'm referring to is the similar premium, let's say you have a $20,000 is what you wanted to put in your policy. If we do a 20,000 all base, or we do a split, or it's still 20,000, but some of that is going to base and some of it is going to PUAs. Now, so when you add the PUAs or that split, one of the biggest differences is you're going to have less death benefit. And so, again, it depends on what problem we're solving, right? If we're solving for death benefit, then we need to focus on the death benefit, right? Mm-hmm. But if we're focused on cash value, we need to focus on the cash value. But an all-base policy is going to have more death benefit than one if we have a mixture of the PUAs with the base premium. Now, to me, the biggest disadvantage of not having PUAs on the policy is the less flexibility with the premium.
Great point.
Meaning, again, if I'm just using that same example, if we have all base policy of 20 grand, that 20 grand has to be paid. That base premium, sometimes I call it the have to, mm-hmm. right? Because that premium has to be paid to keep the policy in force. Now, when we have an all base policy, the entire premium is the have to. That has to be paid each year. Now, if you have one where there's a mixture of PUAs and base, that's going to add some more flexibility. And also we want to be upfront with these PUAs. There is a cost to it, or they're often called a load, right? And each company has a different load on these PUAs, but there is going to be a cost to it, right? But the reason why there are those costs is a few. For one, there is a premium tax that the insurance company needs to pay to every state. And the interesting fact, we're in Nevada. The top revenue source is gaming, and then mining, then insurance premiums. Okay, so it's a big revenue source. Also,
that's thanks to us.
Yeah. Also, there's a commission, right? So I mean, the commission paid on a PUA is pennies compared to what is paid on the base policy. But however, there is a cost to the insurance company for those commissions. Also, since there is a death benefit to that PUA, even though it's much smaller than the base premium, there is still going to be a death benefit. So there's a cost of insurance there. But also, because of that death benefit, that means the insurance company is required to have some reserves for that death benefit. What the insurance companies will do to account for all those is to have a load. Okay, so if you put $1 in PUA, the full dollar is not going to show up in cash value because of that load. But one thing I like to keep in mind, if we own part of the insurance company and we share in the profits, right, is it possible for them to overcharge us if we end up getting a piece of the profits? You know, one thing we got to remember when we're using infinite banking, we're using mutual insurance companies, which means it's owned mutually by the policyholders. So one thing to keep in mind as well. Another thing to be aware of with PUAs is that they need to be added when you get the policy issued. So if you have a policy, maybe you got a whole life policy and it didn't have the PUAs on there, sometimes it's possible to go through underwriting to add it, but it's typically not recommended. But we need to make sure that PUA is going to be on there from day one. Now, so there's disadvantages, but there's also a lot of advantages for having PUAs. Cameron, you want to share some of those?
Yeah, absolutely. A lot of the advantages are going to be the opposite of what Anthony just listed here, but I've got a couple extra that not a lot of people consider when they're looking at PUAs. Obviously, the advantages of adding the PUA to a policy, number one, is going to be early cash value, right? So we get immediate cash value that's going to be available for us to turn around and borrow. Like Anthony mentioned, that PUA, in our opinion, is the most efficient type of premium if you can design it right up to that MEC line without actually creating a MEC. So that's one of the most efficient ways that you can design a policy for cash value. The third point that I would make here is the PUA on this type of design is where you're going to find all of the flexibility. So I'm saying just what Anthony said, but opposite now is on that base premium. If all those dollars are going to base premium, if you have very little flexibility on your premiums moving forward. If we've got 70, 80% of those premiums going to PUA, man, we've got the option of reducing those premiums in any given year based upon kind of our finances. And so maximum flexibility is what we're going to be looking for. And then also, on that flexibility is on the PUAs is when you read those PUA provisions on the contract is you want to make sure you understand them. You want to be able to max out that PUA 1 year, take it all the way down to zero, right, or close to zero, and then max it out the following year. And ideally, if you can have a catch-up provision, that's like best case scenario. So what a catch-up provision is in that year in which you reduced your PUAs down to zero, the following year, can you not only take your PUAs back up to what you wanted to pay or scheduled to pay, but you can also pay the PUAs that you missed. And so you want to make sure that you read those PUA provisions on the contract before you put that in place and make sure you understand what those are. That is one of the things that we do during annual reviews is we look back and see how much the PUAs have been paid or if there's any catch-up PUAs that we could pay if we're able to do that. So really great option. Some companies have like a 1-year catch-up provision. Some companies have catch-up provisions where it's up to a certain dollar amount. And man, I wanted to share the story with you guys is because I kind of alluded to this one earlier, but we were talking about PUAs, it was like a year and a half ago or so. But a client called in and said, hey, here's what I've got, right? I've got this old policy. I don't know what to do with it. I started off funding it. I haven't really looked at it in a while. Can you tell me what I got? And I said, yeah, absolutely. So I looked it up, started reading through his contract, and the company that he was with is he actually had a 7-year window where he could catch up his PUA options. So his scheduled PUA was right at $3,000 for the year. So this guy had not paid a PUA in 7 years, and he was able to dump over $20,000 directly into that policy. Best case scenario for this guy, number one, is he didn't need to start a new policy, right? And number two, his wife, who the policy was on, didn't have to go through any additional underwriting. And three is he was able to drop 20 grand from his checking into his policy. And now if you look at the rate of return internally on the PUAs in a policy, man, those are right around 4%, right? And so again, great option for this client. We didn't have to start a new policy. We were able to use what he had, and he was able to hit the ground running. The next point that I would make for you
Wait, Cameron, real quick.
Yeah.
Just to clarify, somebody called in who's not a client, and they had an existing whole life policy. So instead of selling them a new one and you getting paid on a new policy, you showed him how he could turn the policy that he did have into an infinite banking policy.
Yeah.
Okay. Well, you sound surprised, but I imagine there's people not all IBC people are going to do that. I just wanted to point out that we're here to help people and to teach IBC.
Yeah.
And if you have something, if you need a new policy, we'll gladly help you. But if you don't, we can give you some instructions on how to maximize a policy that you do have.
Fausto, you know this, but most of the time, right, we're usually dialing people back on premiums, right? We've said this before, but a lot of people call, they're super excited and they want to try to get every dollar into a policy. And so we're usually walking them back. But that would be an example of, right, hey, we'll look at what you guys have. If there's something that's a great fit for you, we'll tell you what to do, whether we need a new policy or not. So hopefully that helps. I was already thinking about the other feature that I was going to add in there is that, man, you look at what was available to this guy is he had 20 grand sitting in a checking account, probably earning zero, and he's able to dump it into the PUAs. If you look at the rate of return on PUAs, I ran an illustration before. I'm scared to tell you guys the numbers because I don't want you guys to call me up, right? But we get a great rate of return just on the PUAs. And if we just conservatively assume 4%, man, that's 4% tax-free. So now this guy has 20 grand earning 4% tax-free. And if you look at his tax bracket, that's like earning 6 to almost 7% just in some sort of investment account. So as your tax rates increase, PUA should be a place that you guys should be looking to stash cash because it's growing tax-free. Really, really good option for a place to put cash for you guys. The last one that I was going to state here was that PUAs are a savior for someone with a rated policy. The reason for that is because, again, we got two parts to a policy.
Cameron, define rated policy?
Yeah. So sometimes somebody comes in, maybe they're a smoker, right? Somebody comes in and they smoke, and the insurance company will give them a standard smoker rating. All that means is there's an additional cost for their health on that insurance that they're buying. And so when somebody comes in, there's two parts of the policy, the base premium and the PUA. The base premium is what's going to be rated. So that means that if somebody is rated as a smoker, right, they have an additional cost on that base premium, whereas the PUAs, they go into the policy as a standard rate. So whether you're preferred or whether you're substandard, that PUA is going to grow regardless of what that rating is. And so that really is a bigger benefit to individuals that come in as a rated policy. So great option for somebody that is rated or substandard, be able to kind of come in, max out those PUAs and still get great growth on their policies. The other one, last point that I have written down here is it increases your death benefit without any additional underwriting. Kind of the same thing Anthony said before is when you get that policy issued is you need to get underwritten for your PUAs. That doesn't mean that you have to pay those because of the flexibility that's in there, but you do want to get underwritten for the max amount of PUAs that you can put in there. And when you do that, what that does is that does increase your death benefit just slightly. So now we've got more death benefit, which contributes to dividends. which contributes to the accumulation of cash value in the policy.
Well done, Cameron.
Thanks.
You know, I want to make a couple notes here. When you'd mentioned of the flexibility, right? One of the, you know, whatever your premium that you decide, odds are there's gonna be a cash flow crunch, you know, at some point in your life, and you may not be able to make the full premium, but maybe you can make half of it. That PUA is optional, which sometimes I call that the want to. Okay, but one thing we need to look at, some carriers only allow you to make that change on the anniversary of your policy, and others allow you to do that at any point. And so also you'd mentioned the catch-up provision. A lot of those are going to be different depending on the company. And oftentimes people focus so much on the cash value and the policy. We also need to take into account the flexibility of the PUAs as far as when you can add them and turn them off, and what the catch-up provision is. For example, the individual who you'd help with that 7-year catch-up, if that insurance company didn't have it, they would have ended up having to start a whole new policy and start up with that slow start again. So there's some advantages there. And also one little interesting thing, this little nerd thing that I think you're of course enjoy. I was preparing for this. I calculated what the death benefit is per dollar for a PUA versus a base premium. So I did a 40-year-old at standard, and for $1, he has $1 of base premium, he has $65 of death benefit. So okay, let's just say 65 to 1. On the PUA, it's 3 to 1. Mm-hmm. So that's another reason why it's so efficient, because the cost and the risk of the insurance company is going to be less.
Great point, nerd.
You're welcome.
Guys, I hope you guys enjoyed this episode, right? We wanted to peel back the curtain a little bit just on the PUA rider so you guys have a good idea whether you have a policy or you're just looking at this. There's disadvantages and advantages to everything, but really when you look at design overall, is you cannot assign a finite value to the cost of the PUA rider, right, or the age of the rating. Is you need to still look at the policy in its entirety to make sure it's a good fit for you. But man, the PUAs, the way that we use them, are going to be the powerhouse to cash value accumulation early on in this policy. So hope that is able to help you guys.
You know, because of the PUA, that's what makes our design not only different for cash value, but also different when people are concerned about their age and their health. You had mentioned about the health, but also we did a podcast a while back comparing a 20-year-old, 40-year-old, and 60-year-old with the same premium. And at the beginning of year one, the 60-year-old had more cash value. Mm-hmm. And the reason being is the design wasn't for the death benefit, but it was because the cash value, and because we have these PUAs, your health and age makes a much smaller impact than most people believe. And I would like to close this podcast by saying, Cameron, a PUA is a paid up edition. Go make a fantastic day.
Yeah, take care, guys.
If you like this video, I know you will like this one. And if you want to learn more how investors use infinite banking to increase their returns and lower their taxes, check this out. If you want to see if infinite banking is for you and have some questions, hop on a discovery call with one of our coaches. You can find the link for that in the description below.